Okay, options basics. Options are derivatives, which means that they're essentially derived from an underlying security. It's the same for any type of derivative, where you're talking swaps, you're talking futures, whatever. They're derived from something else. And in this case, we're talking about stock options, so they're derived off the underlying stock equity. Now, options are leveraged and highly leveraged, especially as you move out of the money. And we'll go on to all these terms later on throughout this video and subsequent videos, which means that it's a double-edged sword, essentially. And that's why people talk about options and other derivatives being risky, because your returns are magnified or multiplied. You can earn hundreds of percent return. Similarly, you can lose more than you invest. And that's why people consider options to be risky. In my personal opinion, anything is risky if you don't know what you're doing. And that's why it's important to understand what you're doing, the proper foundation, and you dip your toe in the water and you build up your knowledge and your skill through both theoretical learning, this type of learning, and then practical learning, actually doing it. Now there's two types of options: calls and puts. Every type of strategy, whether you're talking a straight out call or put, or you're talking a spread, or you're talking about strangle, straddle, condors, butterflies, whatever you're talking about, they are all derived from putting calls and puts together, either long and short, or both long, or whatever you're doing, 2-for-1 spreads, all these sort of things. They're just adding calls and puts together. And you can break them down into their separate components. So if you remember that and you don't get carried away with all these different strategies, you look at them in their basic components, they're actually fairly easy to get the hang of. Now, calls give you the right to buy if you're a purchaser of the option, and puts give you the right to sell. So essentially, calls are generally considered for the bullish type view, and puts are considered for the bearish type view on the market. Now, all you can do with calls and puts is either buy or sell them. And as I said, every strategy is involved with just putting calls and puts together, either as long as a buy or as a sell. Now, one of the fantastic things about options is that you can make money in all market conditions. Now, the market tends to go up a third of the time, down a third of the time, and trend sideways a third of the time. If you're just an investor in equities, well, then effectively all you're doing is investing in the market for a third of the time, or for that that bullish third. With options, you can take advantage of the market in all conditions at all the time. You just got to put the right strategy in place, which allows your profitability to be far higher, because you're spending the whole time investing, trying to make money, as opposed to just a third of the time. Now, in the US, options trade at a ratio of 100 to 1, which means that if you buy one option, effectively you're trying to buy or sell, or your exposure is to 100 underlying equities. So buy one call, effectively that's giving you the right to buy 100 stock. In Europe, it's 100 to 1, the same. In the UK, it tends to be 1,000 to 1. Now, we're not going to go through the intricacies of options pricing, the methodology and the model itself, but we do need to understand the inputs. That's absolutely crucial. If you don't understand the inputs, and to a lesser extent the Greeks of options, then you're behind your competitors, because they do understand that. It's important to understand as much, if not more, than the people you're competing against. Now, there's 5 key inputs into options. First is the price, hopefully fairly self-explanatory. That's just the price of the underlying equity. Let's say, for example, it's $10. The strike. All options and all derivatives are just a contract, and the option has a strike, a price, where in the case of a call it's giving the right to buy, and in the case of a put it's giving the right to sell. So if the stock's trading at $10, a strike on a call, for example, might be $12, which is giving the person who buys the call the right to buy the stock at $12. So it's an input, and it's obviously a fairly easy input into the option pricing model. Time. An option can runs for a certain life, and then it ceases to exist. So it can run for say 1 day all the way out to 2 or 3 years. In the case of leaps, which are fantastic options in stocks, and we'll get into that later on in the video. So that's the time, the duration, or the expiry or expiry date that we're talking about for an option. Interest rates and dividends. Interest rates tend not to affect the option pricing particularly much when it comes to stock options, but it's still an input and it's worth knowing. The interest rate is equivalent to whatever time frame your option is looking at. So if you're looking at a 3-month option, you want an interest rate to be the 3-month LIBOR rate or Fed fund rate or whatever you're putting in. If it's a 2-year option, you want to put a 2-year interest rate in. Fantastic thing is that there's an option pricing model that I'll show you later on where you put in the time and it automatically populates the interest rate for you. We also need to put in the dividends. When a company pays a dividend, it effectively is giving away its cash, its value, and therefore a company's price falls. And when anything affects the price of a company, we need to reflect it in the option inputs. So that's why we put dividends in there. And again, it's a fairly easy input to put in. A little bit trickier when you're talking about short-term options, but it's not too difficult. Volatility is how volatile, how much does the stock move around. Now, people tend to use historical volatility, which is the past movements of the stock, and then they predict the same volatility going forward. So that's the future volatility, and that's what we need to input into an option. So we need to say, if an option's running for the next 3 months, how volatile do I think it's going to be over the next 3 months? How much can the stock move? Payoff diagrams. Now, very popular in understanding options. Payoff diagram is looking at an option on expiry. So this is the day that the option ends. Now, for a strike, a long call, this is assuming that the person has purchased a call. When you purchase an option, you pay a premium, in this case 50 or 50 cents, and this is per option. So you buy the call option. The maximum you can lose is the premium that you've paid for it, in this case 50, so that's why you've got a flat line. The maximum loss is 50, and that's why Wall Street, etc. say, oh, it's so good to buy options, because you know your downside, you know how much you can lose. Well, I want to challenge that as we go through this, because yeah, you might only lose 50, but you lose 50, well over 90% of the time. It's like death of 1,000 cuts. However, for the understanding of a call option here, we're looking at a maximum loss of 50. The strike price is at $500 or $5. So that's where the option holder, the person who's bought the call, has the right to buy the security. So if the stock goes above $5, he's going to exercise the option and buy the stock at $5. Now, given that the options cost him 50, it has to rally, or the stock has to move up to 550 for him to break even, because he's buying a stock at 5. If it's moved to 550, then that will cover the cost that he's had to pay, because you have to always pay that to the option seller. And thereafter, it's the equivalent of just being long the stock. The 45-degree line says that as the stock rallies, you'll make more and more money. Put is the exact reverse. We're looking now at the downside of the stock. So the long put holder has the right to sell the stock, in this case, at $500 or $5, and he pays 50 cents for that right. So you can see it very much as an insurance policy. If you are long this security and you are worried about the stock selling off, but you don't want to sell your security, you could buy a put, and that would give you protection. If the security goes below $4.50, then you start to make money on your put, and that offsets the loss you make on your stock, for example. If you were just outright bearish, if you thought the market was going to fall or the stock was going to fall, you could buy a put to profit from it. Short call is a mirror image of the long call, as you expect. This is simply the person who sold the call. So the maximum that the profit that the person who has sold the call can make is the premium, which in this case is the 50. So that's the flat line at the top. So he can't make any more profit than the premium that he receives. And he receives that premium immediately on selling the option. And the loss potential for a short call is unlimited. If the stock rallies heavily, then he will lose effectively an unlimited amount. It's equivalent of being short the equity itself. So if the stock were to double, you could lose a far greater sum than the amount of premium that you receive. And that's paid effectively over to the long call holder. Similarly, for the short put person sold the right to downside protection. So he would receive only the premium, in this case 50, and if the market sold off heavily, he would be forced to buy the security at $5, and the person who has bought the put would have the right to sell the security to that person at $5. And this person's break even is at $4.50. And if the market goes below $4.50, then they start losing money on their position. Options lingo. Holders is just a fancy name for saying, I like to buy an option. It's the buying side. And writing is for sellers. So if you hold an option, you've bought an option. If you've written an option, you've sold an option. Strike, we've already covered that. Every option has a certain strike where the option effectively becomes exercised or where it takes effect. Expiry or expiration date, that's the term of the option. The premium is how much the person who is buying an option has to pay and how much the person who's selling the option receives. In the money, at the money, and out of the money. Generally, people who are trading options will trade out of the money options, and that's because they get more bang for their buck and they're less expensive. Okay, now an in the money option is an option where if it was exercised, if you were to say, hey, I want to close my option and either in the case of a call, buy the stock, or in the put, sell my stock, there would be some value in doing that. So in our case, example earlier, if we had a strike of $12 and on a call, if the underlying had rallied above $12, it would be considered in the money. So a $13 or $14 in the underlying market would have a $1 or $2 value, so it's in the money. At the money is when the underlying and the option strike are one and the same. So if the underlying market was at $12, then the option would be considered at the money. And out of the money is when if you exercise the option, there would be no value in it. So, most options, when they expire out of the money. So in the case of the $12 call, if the stock was sitting at $10, then effectively the option at $12 is out of the money, because if you exercised it, there's no way you'd want to buy the stock at $12 when you can buy it at $10. American versus European. American options you can exercise at any time up to the expiry date. Easy to remember, or the rule I use is any time. American starts with A, obviously. European option starts with an E. Well, you can only exercise them at the end of the expiry date. So there's no early exercise on European options. Delta. Delta is a very, very important term, and we'll go on to that on the next slide because it deserves that sort of attention. Option delta. It's a number between 1 and -1, or in some option models, 100 and -100. From 0 to 1 are call options, and from 0 to -1 are put options. And the option delta has a number of definitions. Actually, there's about 4 different definitions of delta, or different ways you can use it, but the 2 most important I've got here. When they talk about option delta, what an option delta tells you is that for every 1 point move of the underlying market, how much the option price will move. So if an option delta had, in this example, a delta of 0.1, then if the underlying market moves by 1 point, the option price will move by 0.1. And so it's telling you how much the ratio of option price is to the underlying market. And the other way to look at an option delta, which I like to look at it this way as well, is the probability of it being exercised. If you've got a delta of 0.1, so we know the amount that the option price changes versus a 1 point change in the underlying market. But what it's also telling you is that according to option theory, the option has a 10% chance of being exercised. And that's very, very important to know. So if you are actually a seller of an option, you know that you have a 10% chance of losing, or put it another way, a 90% chance of winning. On pretty much every option or derivative or general investment products, there's some sort of disclaimer. This is a sort of standard disclaimer that you see. But the way I tend to think about it is that if you don't know what you're doing, you shouldn't be doing it. It's the same for anything, whether it be investment or anything else in your life for that matter. You need to learn and be an expert in it if you want to do it well, if you want to succeed in it. To me as well, if you know what you're doing in options, options represent probably the lowest risk investment out there. And that'll probably surprise a lot of listeners, but it's actually true, and I'll prove it to you as we go forward. The two general option uses that are sort of banded around are for speculation and for hedging. So speculation is saying, hey, I'll just take a punt on the market. Because they're highly leveraged, they're seen as a fantastic way of being able to make a lot of money quickly. Hedging is the other way. It generally is seen as if you own a stock position and you want to protect yourself, you can buy a put as an example and hedge yourself. There's a whole lot of other sort of strategies you can put in place, but that's sort of the hedging side. We're not going to spend any time on speculation or hedging. Speculation is gambling. Not interested. I like making money and I like to sleep well at night. Hedging, well, yeah, that's all well and good, but there's 1,000,001 books out there and things about hedging. That's not what we're focusing on. What we're going to focus on here is yield enhancement and to more extent, investment. Now, yield enhancement we'll get onto as strategies, etc., but options represent a fantastic way to earn more return on a portfolio. So that's yield enhancement. And what you will virtually never ever see is the term of using an option as an investment. Well, you couldn't be more wrong. And because people don't talk about it, and because the 99% of people don't understand options properly and only regurgitate what they hear on other websites from other people who don't know what they're talking about, or books that are really not particularly well researched and written and not by proper traders, they don't know that you can actually invest in options and earn a fantastic return. And that's what we're going to concentrate on throughout these videos. Yield enhancement and investment represent a fantastic way of earning a brilliant return on either your portfolio or just in general.